Hey everyone, welcome back to the MHP Show podcast. I have another special guest with us today, Miss Amanda Cruz with Voyage Investing. And I've seen Amanda on different podcasts in the past. We're like LinkedIn acquaintances. And I was like, I need to reach out to her because she does provide valuable content on LinkedIn. And I know she's, in the MHP space. And I was like, I got to get her on the show because really, I noticed that I have a lot of men on the show. I'm like, there's also women that are doing big things in real estate investing. And I definitely wanted to get you on the show. So welcome.
Hey, thanks, Derek. Thanks for having me. And yeah, looking forward to actually chatting with you and not just seeing stuff that you post.
Yeah, for sure. For sure. Where are you from?
Raleigh. We're outside of Raleigh in North Carolina.
Got it. Yeah, I noticed you have a little, twang like I do. And, it's always good to meet someone else. I've lived in Florida. I've lived in Florida for like 12 years now. I still have my accent. And so some people say I don't have an accent. And then some people say, oh, you sound like you're from Texas or something. So
it depends on who you're around too, right?
That's true. So, yeah. Well, so we're going to talk some shop today and talk MHPs and, how you got started in your journey. But have you always wanted to be invested in real estate or kind of what did you do first?
Most recently, I managed a team of analysts for Capital One. So I went the traditional path. Like I have a chemistry degree, which is as you can imagine, zero use in mobile home parks. And I have a master's in applied statistics, which I also never use because, by the way, if underwriting has to be that complicated, maybe you shouldn't do the deal, right? So I have these, degrees. I went that path, climb the corporate ladder, all that stuff. But I always wanted to do something for myself. I remember being in college and we were renting a place. There were 4 bedrooms, and I knew the landlord. Her daughter had gone to school before me, and that's why she bought it. And I could tell, I could run the numbers. The mortgage payment was going to be something like $1,000 a month. And we were paying $400 for each of 4 bedrooms. So I was like, oh, well, dang, there's got to be something here. Maybe I can own real estate one day, and then like a decade later, my husband and I decided, hey, let's actually do this real estate thing. And we just started with duplexes, burrs, that type of stuff. But then I heard about Lonnie deals. I'm sure you know what that is, the one-off mobile homes. So we did a few of those and really liked that and started buying parks after that.
Yeah, that's awesome. It looks like I think you sent in your bio that you started in 2020, and I wanted to go back to that and just mention something you just said. You mentioned chemistry degree. When I was in high school, chemistry, like I don't know, there was something about the class that I hated, and I like my eyes rolled in the back of my head in that class, and it was so difficult for me to even like I did well in like other classes, but that one just crushed me.
So many people hate it, right? A lot of people really, really hate chemistry, but for whatever reason, I did like it at the time.
Yeah. And I think one of the things you said there was super, super key. And I think a lot of listeners need to think about this. If underwriting is so complicated, maybe you shouldn't do the deal. Like I want you to talk about that a little bit because, I think some people, I get questions from people and they're like, well, how do you underwrite? Like, and they make it so complicated. And, you work with somebody and you see them doing this stuff and a year later, they're still asking you the same questions because they don't like, pack that a little bit because I love that.
So at a high level, here's how I think of it. And there are a lot of people who may be in the multifamily space or some of these asset classes where you have to go in, you have to get bridge debt and you have to refinance after so many years and return capital. And you have to move all those pieces in order for the project to work. I don't underwrite like that. I don't underwrite that you have to go in and refinance after 2 years in order for the project to work. It should just be simple. And so for us, we need to do better than breaking even out of the gate. I don't want to be losing money on a park out of the gate, but we're buying stuff that has so much upside that's really the price point that I care about, is how can I do better than breaking even out of the gate? And if I can do that, there's so much upside, it's going to work. The hard part is finding the communities where the price that will have you not losing money out of the gate, the potential seller would accept that price. That's honestly the hardest part. But other than that, it's helpful to be in the space because we know the expenses, right? We know how much it's going to cost for trash, and we do septic systems. So we have managers, we know those costs. So once you have an idea of the expenses, it's really a matter of, where are we today? What is that income today? And we raise rents slowly. We're not going and taking something from $150 to $300 a month in 6 months. Like, I can't sleep at night. I have little kids and I'm not going to do that. So it's, hey, if we're raising rents $50 out of the gate, $50, maybe 6 months later, getting to market over a 3-year time period. We know our expenses. Can we do a little bit of infill? And that's really all there is to it. You don't have to run these complicated scenarios with financing.
Yeah, I agree. And I love what you said there, because I think it's important. And I think people get mixed up today because there's less deals that actually work. And so when you're looking at these deals, I think people like, am I questioning myself? Am I doing this right? And you're like, no, the market's a little bit different now. I remember in 2021, I mean, every deal you looked at, you could probably figure out at some point. But, I think it's a couple of those factors, and there's not that many deals that look good now. And so you're like, you're trying to throw the numbers around to like, hey, how can we make this deal make sense? And, a key thing for me when I'm underwriting stuff, because I actually love underwriting. I think it's a lot of fun. I love to see what the property's going to do. If I have to really look at it and think about it and like really dial in how this deal is going to work, I know I need to pass on the deal, because the good deals, I'm like, instantly, I know that they're good deals.
Yeah, because there's a per lot cost, right? And so anybody who's been doing it for a while, you just know the per lot cost, it's going to make sense for you because you know what the lot rents are in your market. And so it just becomes like second nature. Oh, they want 72,000 per lot. That's a joke. I'm not even going to bother, right? You don't have to waste your time. But you're right. It's harder now and it also has to do with your cost of capital. Like, for us, we tend to bring in investors, right? And so our cost of capital is higher than some firm that's using insurance money and they only need to pay their investors 6%. Yeah, they can pay more money for a community. But for those of us who bring in passive investors and have certain returns we're trying to hit, it really is just harder. So if you're underwriting and not finding deals, that doesn't mean you're doing it wrong. It just truly is harder to make the numbers work these days.
Yeah, for sure. And you mentioned $150 lot rent. Where are you buying deals for $150?
Dude, in North Carolina,
wow.
I mean, that was a few years ago, but even today, like, we just bought a park this week and the lot rents were between 200 and 225. And, we had the guy raise them to 250 while we were under contract to purchase it. But yeah, I mean, $200 a month. There are some in North Carolina that are still in the hundreds, in the high hundreds.
Wow. That's crazy. That's crazy to think about, because I'm based, we buy around like the bigger metros typically. And, in Florida, like, you're not going to find $200 lot rent in Florida. Actually, yeah, I take that back. There are some places like in the, I don't know if you know where Lake Okeechobee is, down by that area in Belglade. It's like South Florida, but in the middle of the state, it's a big lake. But they tend to have some lower rents there. But around where we're buying, we're now like $200. Like, you're not going to see that. That's interesting.
Do you do primary markets? You do all first tier?
Yeah. Okay. That's just what I found, and I like, because it's. When I'm looking at deals, I'm looking at, my exit strategy. And I know, yes, there's a higher barrier to entry. Yes, we're going to pay a little bit more, but there's, significant more upside in rents and, market growth and things, I know I can probably exit for a lower cap rate, which, we're talking about underwriting, like put a 6 cap on the exit versus a 6.5 cap and watch how much it affects the returns versus, or a 7 cap versus a 6 cap. It really does affect the returns pretty dramatically, honestly. And, our thesis is that, we just like those markets. We can move faster in them.
Yeah, absolutely. And do you do 5-year holds then, or what hold time period do you do?
Yeah. I mean, we leave it open, because, when I talk to investors, it's like, hey, if we had a gun to our head and we had to sell and it was 2023, like it wouldn't have been good for you. Right. So we like to sort of keep it open. Like yes, we'll do 5-year holds. It's typically what we're looking for. But if the environment isn't conducive for us to do really well, then maybe we won't. So, but yeah, I guess standardly we do 5-year holds, but it's sort of open. It's not set in stone. What about you guys?
Yeah, honestly, when we underwrite, I do that, but I don't want to sell our assets. And I go back and forth on this a lot with different investors because I get it. I get it. You're turning and burning your money, and that's how you maximize net worth growth. But at the same time, in this asset class, where so many less are being developed than in other asset classes, we want to hold on to them. So we've even told on the ones where we have equity investors in the syndications, like, hey, look, we'll look to return capital in 5 years and we want to hold for at least another 5 because we want to have long-term, ownership in this asset class. And then sometimes we'll buy with joint venture partners or something like that, where it's like, hey, if you want to maximize your returns and sell in a year and a half or two, like don't partner with us because that's not what we're looking to do in this asset class.
Yeah.
I mean, there's a good story there. It makes sense. You can definitely, force your net worth higher that way. And I do that with other assets. Like I own a warehouse. Dude, as soon as we maximize that, we're selling. But there are a lot more warehouses in the world than there are mobile home parks. So I just look at them differently.
Yeah. Yeah. And I think, the interesting thing about that, and investors are talking about, maximizing net worth. And I'm about, multiplying net worth. But even now, like we were trying to sell a few assets and the numbers we could get like 7.5 cap. It was like, okay, but on a refinance, I think we can get a 6.25 cap or a 6.5 cap. So it really, yes, we're not, able to liquefy everything, but still we get some liquidity and, net worth on paper is actually, it's better. And it keeps us like we can ride until the market's like really good again from an interest rate perspective. And then, we can sell at a 6 cap. Right. But, we've looked at that and, honestly, again, that, when you're talking about, $50 million worth of stuff, the difference between the 7 cap, 7.5 cap and the 6.5 cap is massive. Right.
Absolutely.
So
yeah.
we're making a decision like based on that. Right. Because the investor is still happy because their net worth, I don't know how much it is per investor, but it's definitely they're keeping more of their net worth sort of in the property because we're deciding to do that. So look, I'm with you on the long-term hold. I like it. But like, if the portfolio gets big enough and somebody says, hey, 4 cap, okay, let's go. Sign it up.
You're right. You're right. There is something to that. It's just, then you have to go out and find these unicorn deals again. And
I know.
It's hard enough to find them the first time.
Yeah, no, that's a good point. That's a good point. And, I've actually been through this thought process in my head. I'm like, okay, these are syndications. So we didn't set them up as ticks. So like we can't 1031 unless I'm missing something there. But, you have to like, okay, 3 years ago, you can sell and then go buy some other stuff if you can find it. And then you can, bonus depreciate everything and sort of, defer your taxes again. But, going into next year, it's only 40% now. And then it's harder to do that.
Yeah, absolutely. I mean, who knows? There's obviously talk about bonus depreciation being extended, which would be incredibly helpful
It
for
would, by the
everybody
way.
listening. Um, but yeah, I hear that. I mean, yeah, I think unless you have like all of your investors on board to trade into another asset together, but that just gets complicated. At some point, you're going to have to sell out. Somebody's going to want to. Yeah, I hear that. I hear that.
Yeah, yeah. Yeah, and I also do like, I find that like most people in our business, they do like the long-term hold strategy because of some of the things you said. And I'm not against it either because I think and you've probably seen the more seasoned your team gets, the better your team, the more experienced your team is, the more seasoned the property gets, the easier it is to operate. Because over time, when you put sort of ethics in and presence on a property, the bad people weed themselves out over time. The people that are causing problems weed themselves out, and so eventually you get a nice community. Everyone's paying online, no one's causing problems. There's still problems, but not like when you just bought it.
Yeah.
We have the very first property we bought was an absolute disaster, and we turned it around fast, but it hadn't. That was at the end of 2020. And so now it's like, okay, this thing just sits there now.
Absolutely. I mean, gosh, the first 6 months is always a total whirlwind. You never know what you're going to run into. We had a resident set his brother's motorcycle on fire at 2 a.m. Like you just, and this is all because they're residents. You don't know, but nobody's running background checks. These people that we're buying from didn't run background checks on anybody, right? So and according to them, everyone's great. Everyone's great. This is an easy community, of course. And then you get in, you buy it, and then you start hearing the real stories and figure out who you have to get out of there. So that's always a fun 6 month period of weeding out the bad apples.
Yeah, it's fun. And you said that, so I thought, so we put together like a 3-part portfolio in July, and we have our little messaging thing. So sometimes I can see the messages that come through on the tenants. One of the parks had, a guy that was a little, crazy guy. And we get a message is like, hey, this guy's son tried to set his dad's truck on fire. And so I was like, man, I've never heard that one before. And you say that someone tried to set their motorcycle on fire. And I'm like, okay.
Oh, they did it successfully.
Like what they do, just pour gas around it and like.
I'm not sure, Derek. I didn't get the play-by-play on it, but I know it was set on fire because the poor 80-year-old lady who lives next door was like, I'm not living like this. We're like, so sorry. They're gone. I promise you. They're gone.
Yeah, it's interesting. Next time, just for me, you need to get the details on the, exact procedure that they use to do that.
Yeah, you see everything in this business, right? It's November now. In October, people in real estate investing circles do like horror stories. And I don't know if you've ever done that with other investors, but like everything people say, you're like, oh yeah, that happened to me. Oh yeah, I forgot about that one because it's like their worst thing that happened. You're like, oh my God, I forgot about that thing in mobile home parks. It's like, yeah, of course we saw that.
Yeah, of course. What's been, you've bought some parks now, and inevitably when you're getting in a new asset class, there's mistakes and things that you can't necessarily learn from a book or learn from a podcast. You have to be there, right? So what would you say are a couple of mistakes that, were big, that were lessons learned that make you a better operator now?
Oh man. The biggest was we bought this community with park owned homes that we were getting for free because we were buying the park for so cheap. The guy didn't want us to walk through the homes. We're like, oh,
Of course not.
it's fine. It's fine. We're getting them for free anyways. So we'll just move forward with it. We're getting this park for so cheap. Oh my God. Never do that. Don't do that. Do not buy a park without walking through those park owned homes. I mean, there's slumlords, but then there's this guy and these houses, like we had to evict multiple people, not for non-payment, but because the houses weren't fit to be lived in. It was terrible. I mean, this one woman with 4 kids was living without a refrigerator. I mean, just like the worst conditions we've ever seen, which should not be shocking. Anybody who's smarter than I am listening is like, well, hello, duh, you bought these homes for free. Yeah, they're in bad shape, and yeah, they were. So don't do that. And then, I mean, to your point, the population thing, like you like to buy in tier 1 metros. We tend to not be, maybe because I'm not as aggressive, I think, on exit valuations. We tend to not be able to make the numbers work in tier 1 markets. So we tend to be in secondary markets, but the same community that we bought for so cheap, the population was not growing there. And that was a huge mistake. I mean, we made every mistake possible with that single park. Like the location's not good, the demographics tough. We bought park-owned homes that we didn't even walk through. Like it is hard in the mobile home park space when you buy so right to go wrong. Like we're not going to lose money there. It's fine. And we have debt investors, right? So they're lucky. They get paid out every month anyways. They just, right? They just get their interest payment. So they're happy as can be. But buying in a place where the population's declining is also something we will never do again. It's just so much harder to infill. It's harder to get the right residents because the residents who stick in a location where the population's declining aren't your top residents that you want in your community generally. So it's just a tougher location all around.
Yeah. And I wanted to talk about that a little bit. And that's, some of the reason, like, because with our business plan, it doesn't work as well in a secondary market. It doesn't work as well in a rural market because of what you just said. It's slower, harder to find tenants, harder to find people to come in and fix up the park-owned homes, harder to do infill, harder to sell homes. It's like harder. But if I'm in, in our Orlando or Tampa market, I mean, we put houses out. You put one on Facebook Marketplace, you get, 50, 100 messages in one day. And so we can be, picky with the tenants, right? We can wait to actually get someone with a 650 credit score or up, even over, like we have people in our parks with over 700 credit score, believe it or not.
That's nice.
And but we learned hard lessons, like, in taking people with lower credit scores because, we have problems. But what else other than things going slower would you say about the, a smaller population like that you would not do again? Is there anything else you could unpack there on that?
I mean, it's hard to infill. So here's a piece that's really important on, I mean, there are smaller cities where mobile home parks are awesome, but when the land value in that surrounding area is pretty cheap, nobody wants to come in and buy a $70,000 mobile home, right? Because they can just buy a piece of land for 10 grand and plop a home on there and buy a home for, like $100,000. So it's a harder sale. So one thing I always look at, like I've had people message me about partnering on parks before, and they're like, oh, it's a great area. South Carolina, man, that gets really rural really fast in South Carolina. And there was this one location. He's like, oh yeah, the guy's willing to sell it to me for this. And you can infill these 10 lots, but he just hasn't done it yet. I'm like, yeah, okay, I get it. He's lazy, but also you can't infill there. You're never going to be able to infill there. You're going to have to rent them, which is fine. You can rent them and then you can sell them a year later. And those individuals don't have to bring a down payment. That's an easier sell as well to the residents, but it's a longer play. And it's a longer time to turn your money over because, you're bringing in your money to set up the home. Even if you have a floor plan line and 21st or Triad or whatever is funding the home, you're paying your 20 grand to get the home set up. Well, if you're having to rent it out for a year or two before you sell it, it takes you longer than to use that 20,000 to infill a whole nother lot. So it's just a slower play, and you need to be able to expect that in your, business plan. So when you do have these locations where the land is less expensive around there, infilling is harder. And also people are more likely to move the homes out of the park. So like even when we're doing handyman specials in that location, we've had them fixed up. Oh yeah, things are looking so nice. This is awesome. Well, the person who fixed it up wanted to sell it. We're like, that's fine. No worries. You just have to, which he already knew in advance, you just have to have them approved by management. Well, he brought this couple that had terrible, landlord history. So they got denied. Well, he was so angry about that, he sold the home to anybody and carted it right on out of there. And that happened on 2 different occasions in this
Oh, wow.
one community, which is so rare to have people move homes out of your park. But when the land around there is so cheap, it's not as rare.
Yeah, yeah. Like we've never had someone move. I think maybe one of the parks, maybe someone moved it out, but it was a weird situation. But
Yeah. I think in all of our other parks combined, there's been one home that got moved out once. In this park, we've had that happen on 2 different occasions, not to mention the ones we had to demolish because they were in such bad shape. Like buying in a bad area is just not worth it. Even
yeah,
though the numbers, when you're underwriting so many times and you're like, oh, it's not working. Oh, this one works great. Yeah. Yeah. There's a reason for it.
yeah, yeah. No, I couldn't agree more there. And I think people need to, to look out, just because a park is cheap and they're offering like really great seller financing terms or something, like doesn't mean it's a great deal. And like if you have, and I did this in the beginning, you've heard me talk about making this mistake before. I looked at deals based on just the money that I had. So I was looking for cheap deals that weren't necessarily good deals. So a good deal to me would have been like, okay, this guy wants 15% down for seller financing. I can put that down, but it probably wasn't a good deal for me. And, you can make mistakes doing that.
Yeah, and there are some people, it totally depends on how you're funding it too. Like if it's just you and you want a place that is not a savings account to put your money, hey, some of these mobile home parks, even in not the best areas, the cash on cash returns themselves are going to be so much better. So that's fine if you just want to pay cash and get your 15, 20% cash on cash return, cool. But if you're, bringing in passive investors with the idea that you're going to go raise the value of the property and then exit, that is a very different plan in a location where the population is declining.
Yeah, totally. So do you guys do a lot of infill on properties? Do you look at infill properties?
We will look at infill. I don't want the infill to be required for the business plan, but we absolutely do look at that. And we'll do like a couple a year per community. We don't have in-house construction. So, we're paying third-party crews. So it is costing us about $20,000 per lot to do infill. And, some of the other guys who have like an in-house construction team can get that cost significantly down. And so we don't necessarily, we'll buy parks where we are going to infill, but I'm not going to buy like a 50% vacant park.
Yeah. Agreed. Yeah. I mean, if I did, the numbers would have to work without the infill.
Exactly.
And then the infill is just, gravy money, which is really how we look at it. And because it's hard. And, the infill stuff and people on the show have heard me talk about this, ad nauseum. Like it is not that easy to infill, especially if you've never done it before. There's just so much coordination that has to go into it. Plumbing, AC, electrical, they got to prep the lot. You got to make sure the mover doesn't hit the neighbor's house or pull it onto the wrong lot or not even pull it onto the lot.
That's the easy part too, the setup, right? Because at least like what you're doing. That's the easy part. It's like the coordination. I mean, working with some of these home development manufacturers. Like we had one home, I'm not kidding you, it should be arriving today. Who knows? We ordered it 6 months ago, Derek. 6 months ago. Every single thing went wrong. They forgot about it. It got delayed here. Unbelievable. And then just having to field all those, right? You have somebody else to field all those Facebook messages. You have to get them approved, and then they have to get approved for financing. Like it's a grind. It's a lot of steps to do the infill. It's certainly not easy.
Yeah, no, for sure. It's definitely, I learned that pretty quick, and we had some vacant lots in the first park that I bought, and it was just, we had to get a permit for the electric, permit for the septic. You had to come and inspect it. You had to get somebody there's just a lot. And, once you start getting into the bureaucracy of the municipalities, I mean, something that should take 3 weeks takes, 6 months. And, there's nothing you can do about that. I mean, we just had a septic tank collapse in on itself from the last hurricane because of the rain. And you should have seen this. It was, if you look on my LinkedIn, maybe you saw the picture, but So the septic guy was like, oh, we can get this permit approved. Like, I'm just going to show them the picture of this and they'll send it right through. It still took them like 10 days to approve the permit for that.
Jeez.
Like, and you can see, like, go on my LinkedIn. If anybody, like a couple days ago, I posted a picture of this and you'll see this. It looks like, someone set off a landmine there.
And so we just bought a park too this week where that had a collapsed tank in it.
Mm-hmm.
And it was sitting there for who knows how long, right? Until our septic inspections went and found out, hey, well, okay, this riser's sideways. Something's up with that, right? It's like collapsed into the ground. You know how dangerous that is? And this owner's just sitting there with that liability, like, like a kid could fall in there. Like the amount of liability that people are willing to put up with is like absolutely insane. But glad you got yours fixed. 10 days isn't so bad. That's pretty good.
Yeah, no, it's pretty good. But, it was sort of like, it's kind of an emergency fix.
Yeah, you would think, but
you would think, right? You would think we have a reputable septic company,
especially when they're there in person, they're like, I can fix this today. Like, oh.
Yeah. Like they could get the guys out there to fix it in one day and they can't. And, so it is frustrating going through that stuff. And I mean, as a park owner, when you get into this business, you'll understand this because there's always going to be a battle of like, you're going to have a guy that comes in and says, hey, I can fix your electric. I'm not going to pull a permit. It's going to be $2,000. I can get it done in 3 days versus the guy who comes in and does it right. It may take 3 months because they're going to do it right. And you're constantly going to be battled with that. It's like, hey, how do we do this effectively, do it right, and not get the cheapest guy in town to come in and do it? And it's going to be so easy for you to say, okay, I'm going to use Johnny, right? But I would caution you and advise you to, we have a company policy now where we always do things the correct way, even if we have to pay more for a great contractor. And you're going to be battled with this if you haven't bought a park yet. I can guarantee it. You're going to have a problem. And, Johnny's going to come in and say he can fix it, no permit one day. And you're going to be like, yeah, F it, do it. And then somehow the health department's going to find out and it's going to make it harder for you. So do things right and pay more for good work.
Yeah, definitely on septic, electrical. Yeah. I mean, it's just not worth it. You have to have your permits there. But I mean, it is challenging sometimes, like, especially if you have like abandoned homes or you get park owned homes, you're trying to sell them off, right? Like you don't need the best contractor. But I'll tell you what, we've made the mistake of using like crappy ones that just, hey, it's me and my 2 friends and we can go in there, and the amount of babysitting that has to be done. And then the fact that they did things wrong. I mean, it took months and much longer than it should have and cost us like tens of thousands of dollars to rehab a park owned home from the 90s. Like that, what in the world? All because we use these, crappy guys. Like it's not worth it. But when you're in a new market, especially, it takes a few bad apples until you find the right contractors.
For sure. Yeah. And I think too, it's a balance between like, okay, what you can go cheaper on and what you can't. Like you said, like septic, electrical, things like that. Don't go cheap on that.
Yeah. The setup contractors. Yeah. Don't go cheap on that for sure.
That either. Yeah. But if someone's going to fix the skirting on the side of the house or something, like, yes, you can get Johnny to go do that, right? For, $50 or whatever it is. Right. So you can do that. But not on the big stuff. Right. And, it's funny. I talk about this in my course. I've talked about on other things. It's like, you need to be a stickler for expenses, right? Especially operating expenses. Right. But you can't be dumb on like, hey, I'm not going to fix the chlorine pump in the well for $500. Right. You can't do that. Like, that's dumb. Like, you should pay that. Like, I'm not going to fix the lift station. Right. You should pay $6,000 or whatever it is and fix it. But being asked to the trash company about the overage they charge you $200 for that they shouldn't have charged you for. Right. So there's a different time to be, a stickler and a time not to be an idiot. But arguing the trash thing for $200, I'm going to argue that all day, because especially if it's not warranted. But I am going to fix the chlorine pump.
Yeah, please make the well water safe for everybody, for your own benefit as well.
Yeah. So what do you think, like, going into the next, 5 years in this business, like, what do you see on the horizon? Do you see, like, I think less deals being done, more deals being done, or like, what do you see here coming?
I think some individuals who have, I shouldn't say individuals, some companies who've come into the space that are more like white collar, not willing to get dirty and do the hard work, I think they could exit the space because it's
Sure.
not, yeah, it's not meant for them, right? Maybe they should go buy some like triple net stuff. It's hard work, and you have to be willing to get dirty and do the hard work and work with the contractors that are pain in the butt. So I think that maybe that will exit perhaps some investors who've come in from multifamily, as the tide is starting to turn on multifamily a little bit, where there are more opportunities there. And perhaps some of those operators will go back to focusing on multifamily, but I still think it's going to be a roll up. I still think the bigger operators are going to continue to own more and more assets that they're not going to part with. And so it's still going to be more and more competitive. And you do have more and more people all the time who want to get into the asset class and, go own a whole bunch of properties. So I don't see it getting any less competitive. Some people are building parks, but not that many in the grand scheme of things, not compared to the ones that are being torn down. And so I just think it's going to continue to be incredibly competitive. Honestly, one of the interesting things in the near term that could be a challenge to some operators is deportations. If there are, illegal immigrants in communities, that could be an interesting thing in 2025 and 2026 to navigate. But ultimately, the need for affordable housing is just not going to be met by the available housing anytime soon. So I still think it's a good space to be in.
Yeah, for sure. And what would you say, I guess, if someone do you think it's still a good time to get in the business now? Because I remember in 2020, I knew someone in the business. They're like, oh, it's getting, there's more people in the business now. It's harder now. But like,
Yeah.
I look back in 2020 and I passed on a lot of deals I should have bought.
Right? Like all of them?
Yeah.
Yeah. I mean, I think that's so true now, right? Do we think inflation's gone? No. Do we think the price of assets is going down? No. Do we think monthly rent's going down? No. So yeah, it's still a good time to own any assets in good locations with good fundamentals for the right price. And so it's more on, can you find them before they're mostly gone in 20 years?
Yeah, true. And I mean, I even think, like, I've got some relationships with some of the bigger operators, and I'm talking to a guy now that, like, he's got, I don't know, maybe 3,000 or 4,000, more than we've got, but he's got a few assets in areas that we like that he's looking to off, right? And so I think you'll have that too if you can build relationships with these bigger companies, because there's probably, I don't know, at some point there'd probably be a couple that we'd be like, yeah, like we've done well on those. It's just like, whatever, let's just get rid of them.
Or just the pain in the butt ones, right? You're like, hey, all of these are running so smoothly, but this one, I just constantly have a headache over there. Like, hey, maybe if someone paid me the right price, I'd be fine with getting rid of it. I think you're always going to have that. You're right, Derek, especially for some of these operators who have hundreds of communities. If they have some that aren't performing like they wanted, or maybe, who knows? They could be exiting one state, or you never know.
Yeah, no, exactly. So I want to talk a little bit more about the like current environment with interest rates and things, and kind of get your take on that. And we just got through the election, and so that was a wild time. I'm glad it's over. I'm glad it's sort of out of the news now, not really. But do you think that the election is going to have an impact on whether, hey, there's going to be more people selling, or like, do you think it's going to have an impact on our industry? I know you mentioned deportations and things like that, but do you think there's anything else that could affect it?
Gosh, who knows? I think the fact that the election is over is helpful for people who are just waiting. So just that in itself, I think some people were waiting for the election and waiting for the interest rate cycle to start dropping. And we are there now. We're on the other side of the interest rate. In theory, they'll keep going down. Rates will keep going down slowly. But as we all know, there was out of the gate, there was a 50 basis point cut. And what happened to 10-year treasury rates? They went up. And yeah, it's like, oh, everyone's so excited. We're coming out strong with a 50-point cut. And wait, hold on. Now we have higher interest rates than we did in the summertime. And so I do think that higher interest rates are going to be around a bit longer, right? When they first started increasing, it was like, oh, great. So by the end of 2022, early 2023, they'll start decreasing again. Well, no, that didn't happen. And there are concerns about long-term inflation. So I do think the interest rates are going to stay higher, which is honestly, I'm happy about that, right? And I think investors in general got so crazy with what they were buying and turning around in 2020 and 2021. Like, everybody needed a level setting, but like, hey, this is supposed to be hard. You're not supposed to just go buy something and turn around 6 months later and make a couple $1 million. Like, that's not how it's supposed to work. And so I honestly think it's good that it is a struggle for people and the interest rates are still higher.
Yeah. And I would agree. And yeah, totally. And I would agree because, it's interesting. If I look back into 2021, just the feel and the consensus around the market, it was like, it was a drug. Everybody was like, hey, we can go buy anything and everything. It was like everyone was so optimistic. And even myself, I got called into that a little bit, where it was just like, oh, these things are going to keep going up and then we're just going to keep going. And you're right. I think people did need a level setting here, because it was just, it was wild. And if I've read books and things about, I forget who actually said it, but that was really like my first recession going through, when I was like actually in business and in it and in like these higher finance worlds and connected with people. So it was interesting that, it's like, when the market is just overly confident and overly optimistic, that's when you need, like, okay, something's going on here, right? Maybe we need to start checking ourselves a little bit before something happens, because if I look back to 2021, that's how it was. People were super optimistic and like overly optimistic.
Yeah. I do feel very fortunate to be in this asset class, though, because like, if we look at multifamily, I mean, they just got it handed to them, right? Like, all that bridge debt. And we are so fortunate to be able to sort of see that, be in the same realm, but our asset class did not take a nosedive like multifamily. So in some ways, we got to learn those lessons without all the pain associated with it. So very thankful to be in this asset class for sure.
Yeah. And I think too, I get asked from investors, and you probably do too, like, especially ones that don't necessarily know the asset class and are just trying to start investing in mobile home parks. They don't understand it. Like, they think that, when the economy, like, if the economy tanks, what happens? And I'm like, well, nothing. Like, nothing, because nothing really does happen. I mean, because the people that live, I mean, look,
you expect like delinquencies are going to go up. There's going to be a bit more turnover, but you're right. On a large scale basis, there's still so much demand that there's not going to be some huge fallout in mobile home park valuations.
Yeah, I mean, it's, if interest rates go up, obviously, you're not going to be able to sell at a 5 cap anymore. So you lose value there, but it's still going to cash flow, and you don't have to sell that year, right? So it's still going to be, pretty level going through. And I just find I have interesting conversations with people that don't necessarily understand the asset class, and like maybe they're stock market investors or whatnot. But I think it's important to know that. And I always explain, like you talked about underlying fundamentals of markets, but yeah, underlying fundamentals of markets and the asset class in general, I think is huge for what we do.
Absolutely. I mean, and also I think everybody learned a hard lesson on their capital structure. Like, we don't have bridge loans. And it sounds like you may not either. So you didn't have to sell, you didn't have to recapitalize. Well, that freedom is what can keep a deal that otherwise, you know, might turn out poorly for your investors. Like, a lot of these multifamily passive investors were completely wiped out of their equity, and they're still going through that. Whereas those properties are fine. It's not the properties that's the problem. It's the bridge debt that's coming due. And on the mobile home park side, there is just a lot less bridge debt. Like, we don't have any, so we have more flexibility. So as long as properties are performing and cash flowing, you don't have a certain timeline where you have to, recapitalize, which it can be a really, really huge help in ways that people didn't appreciate a couple years ago.
Yeah, for sure. For sure. And I think, we can even learn, a lot from that, from what happened to multifamily, and just really, we even had some deals that were floating rate debt. Like, we bought obviously, great assets with a lot of upside. So there was a lot of, like, after the turnaround, the deal's a 10 or 12 cap, right? So there's a lot of margin of safety there, but still it eats your cash flow. Like, we had a deal that was going like super well, a couple, like 2 or 3 deals. There's no cash flow. Like, these deals were going to be spitting cash flow like crazy, but because the loan payments were like I think a couple of the loan payments like 2.5 or tripled almost. Like, we were still, yeah, it was crazy. It was crazy, but we ended up restructuring it and kind of, figuring it out. And those deals, we have those deals today, and they're fine. But it was a weird 6 months there for those. It's just like, okay, but we were happy we bought the deal correctly. We were happy we didn't buy it at, a stabilized 5 cap. And, upside is just rent increases for the next 5 years. But these were value add that we knew after the first year of turnaround, it was going to be a 10 or 12 cap. So we had a lot of margin of safety there.
That's an interesting point you bring up, because in theory, stabilized properties are lower risk than value add properties, right? They're already performing. There is something to that being lower risk. But I really like the value add piece, just like you do, because it gives you that buffer. If things change in the economy, like that in itself, if you know how to execute and you have an operator who has proven their performance before, that in itself provides a good risk mitigation in, forcing that value up, forcing the income up, that you can't do if the economy shifts and you bought a stabilized asset for a low cap rate.
Yeah. Yeah. You can't, right? There's just not that much, there's not that much you can do. And, I think because the way we buy deals, because we, learned lessons the hard way in the beginning, like, we know how to execute on heavy value add properties. And that's why we stick to the markets that we know, because I know them. I know I can buy a park like this, our criteria to buy in these markets, and we can execute the business plan to a T. Just because we've had experience in that market and we know how it works, and we know, just our value add component. It's like a standard process now. We're going to do step 1 through 15, and, on the other side of it, we're going to be okay. So, yeah. Well, hey, Amanda, it's been great talking to you, by the way. Anything you want to leave our listeners with? Where can they find you, or anything?
Hey, Derek. Yeah. I mean, thanks for having me on and talking mobile home parks for a while. And our website is voyageinvesting.com. So you can join our investor circle if you're interested in the kind of stuff that we're doing. And I'm also on LinkedIn, as Derek mentioned, Amanda Cruz, Cruise.
Awesome. Well, thank you, Amanda. And thank you, everyone, for tuning in to the MHP show. We'll catch you all next week. Please like and subscribe. Peace.